You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. Thanks for tuning in to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
Hi, everyone. Great, thanks.
Where are you calling in from?
Today I'm...
Oh, nice. That's where I'm from. So say hi to everyone, and I hope you have a nice time.
I will say hi to every single person I meet on this site for them.
Good. We probably know each other. So, all right, let's get started with the news. What is the latest? Let's start with maybe the rates.
Yeah, for the rates, I mean, obviously what all eyes are on is what was the impact of the ceasefire in the China-US trade war last week. There is not a lot of data on the demand side. There's a lot of anecdotal data. There's a mountain of cargo that is going to move from China. There are no solid data sources. How big is that mountain? I actually tried here over the weekend to quantify it a little bit. And the way you potentially can quantify it is if you listen to what both carriers and forwarders have been saying the last few weeks, how much of a downfall have they seen, then you're talking 30 to 40% downfall. Now, just because they have that much downfall doesn't mean that that's the amount of cargo that is then piling up. What likely has happened over the last 5 weeks, in the first few weeks, yes, a lot of this is just piling up in containers, but then increasingly factories would have reduced their output as U.S. importers were not placing orders. But some of the Chinese manufacturers might also take some of these goods and try to sell them elsewhere, putting them on ships to, for example, Europe. So again, there's a bit of fluffiness. But the ballpark estimates I made means that you have somewhere, rough terms, between 180,000 and 500,000 TEU of cargo waiting in China to be shipped. This is very substantial. How much or how, that's going to lead to congestion in the U.S. kind of depends on which end of the spectrum we're in. This can go from a nuisance problem to something that's very severe. We simply don't know the magnitude yet. But all of that to basically also say there was a mad scramble from shippers to try to get this cargo moved also during the past week. And the vessels are, of course, not there. As we talked about on previous of these podcasts, there's a significant amount of blank sailings. And the carriers need to get the vessels back into position. That's only going to happen during this week and next week. So how much did that then influence the rates? Here's where life becomes really interesting. This is where I know methodology is always boring, but it's crucial here. Other spot indices tend to be based on, for example, what are the quotes? And of course, those indices tend to show a significant increase already last week. But the difference here with the NYFI is this is based on the spot rates paid by cargo we know factually actually moved, which means we can only get the data into a NYFI once that cargo has actually been loaded onto a ship and moved. And since it takes time from the point where you make the booking is accepted, you pick up the empty container, you load the empty container, you gate it into the port, the vessel finally arrives, the vessel finally sails. And then you need to get the data in and cleanse the data. That means that the NYFI index from the last week shows only a marginal change. And that's simply because a lot of the cargo that was directly impacted, we only know the effect of that during this week.
So we might see it reflected in like 2 to 3 weeks in the NYFI index.
I would expect to see some of this reflected already in the next NYFI reading that's going to come out here on Friday. So we'll see what happens when that one comes out. So this is not necessarily, you can say, a flaw in the NYFI. It is more a reflection of, if you really want to measure reality, in this case, prices paid for cargo that actually moved, you're going to have to wait until reality also happens. The problem with measuring a quote is the quote might be perfectly accurate. However, it might turn out if the quote was too high, nobody is booking at that rate, they're moving to some other quotes that are lower. Or if that quote is insufficient to secure your space, you might actually also see the carrier then not loading that cargo, rolling it or rejecting the booking. So this is where fine with quotes, you can get the data faster, but they're not necessarily as accurate in capturing what de facto is happening in the market. But I think what is safe to say is there is most certainly an upwards pressure on spot rates out there in the market. And I think we're only in the beginning of it. I would not be surprised to see rates increase measured in the thousands over the coming weeks, given what we're seeing transpire right now. So I think everybody should brace themselves for that situation.
And are you talking more broadly about like beyond TPEB?
Right now, yeah, right now it is the TPEB because that's the one that is impacted by the new pause on the China tariffs. Because this is really the main thing that changed over the past week. Everything else is the way we have now. I wouldn't say we known and loved it, but we at least knew it here over the past few weeks, right? With everybody else being on pause for the tariffs. But the China change was the really big thing.
Yeah. Okay. All right. Yeah. So it sounds like we're going to be seeing a lot of congestion coming up. We're going to be seeing, a lot of people trying to get their cargo out all at the same time. It's going to push rates up pretty high, most likely. So we'll be keeping an eye on that. But interesting findings here.
Yeah, and now we
Um,
are on the topic exactly of the findings. I think this might be also a good point of talking about something that I think is touched upon far too rarely. Because to many, there seems to be this perception, at least, that 40-foot rates, 20-foot rates, they kind of move in sync. Sure, I don't think anybody has the illusion that a 20-foot rate is exactly half of a 40-foot rate, which of course it isn't, because the amount of work needed to load and offload a 20-foot is the same as for a 40-foot, just to make one example. But I think one of the interesting things of looking in on the NYFI index is precisely to see a bit over time, how do these things move versus each other? And we've got a couple of graphs that we're going to share. If you can try to load one up. Exactly. So what I try to look at here is over the past 2 years, what is the price premium for shipping a 40-foot versus a 20-foot? Again, without any pre-knowledge, you would assume obviously it's more expensive to move a 40-foot than a 20-foot in terms of spot rates actually paid. But what we see here is the difference. There are several things that turn out. On some occasions, it is actually more expensive to ship a 20-foot container than a 40-foot container. This has been the case for quite a while this year. And just this week, we did below the zero line again, which means if you want to ship a 20-foot container from China to the US West Coast, at least on the spot market, this right now costs slightly more than shipping a 40-foot container. It might sound somewhat counterintuitive. Why on earth might that be the case? But the key here is you need to think also in terms of equipment repositioning. What are the types of equipment the carriers would prefer to move, not to move? Where's the equipment actually located at? The other thing that I think is actually more important here is look at the variability. Look at the extreme changes that we've seen just over the last 2 years in terms of the price differential between a 40 and a 20 foot. Now, when you talk price differential, this one, of course, is simply shown in US dollars. What was the difference? You can then argue, sure, but if prices go up, for example, the difference would also go up if this is just a share. So we have a second graph to show where instead of showing the price premium in dollars, we show what is the 20-foot rate as a share of the 40-foot rate. And I was about to say, at least for us dinosaurs who's been in the market for a long, long time, there seems to be this kind of rule of thumb on the Trans-Pacific. That, well, 20-foot rates are maybe around 80% of the 40-foot rates. But as the data also shows, this is not necessarily true. This is still extremely volatile. Obviously, when this goes above 100%, these are the cases where spot rates actually paid for actual cargo moved. In some cases, were above the 40-foot. So all of this to basically flag that anyone that has the notion that if you're moving cargo in 20-foot containers, that it's fine just to follow what do we see of the market indices out there, that is a very, very dangerous exercise. And for most of the spot rate indices out there, it tends to be measured purely in terms of dollars per FFE, which usually is reflective of what's the 40-foot rate. So anyone shipping 20-foot containers out there really should do themselves a favor not to rely on, I was about to say, the more well-known indices out there, because sure, they can be fine for what is happening in the 40-foot market. But if you are active in the 20-foot market, the volatility and the differences are simply so large. So you have to use a specific 20-foot index if you want something that actually reflects the relevancy for your specific cargo. So this was all to say, at times it's good to step away from, I was about to say, the headlines in terms of what's the spot rate per 40 foot out there, because there are nuances down here that are actually incredibly important for a significant subsegment of shippers. And in this case, on the Pacific for 20 footers.
Yeah, this is really interesting. I've always heard it to be 80% or so of a 40-foot container, but I'm really surprised to see how frequently it fluctuates between like 80% and even over 100%.
Yes. And I think for many, this might actually be a surprise. And I hope at least for the ones that are dependent on shipping cargo in 20 footers, and some definitely are, especially if you're moving heavy cargo, that this perhaps helps to get some more insight in terms of how do you then manage your risk? What are the relevant data you should be looking at for your cargo specifically? And I think what we're going to do in the podcast also over the coming weeks and months is at times try to dig into some of these nuances where we certainly do see, because not only between 40 and 20 footers, we also see significant differences at times if we don't look at the usual, I was about to say, Trans-Pacific China to US, but if we look at some of the other sub-trades that are happening out there.
Yeah. So do you expect this to follow any sort of pattern moving forward with the recent trade ceasefire announcements and what we think is coming in the coming weeks?
You can say for the difference between 20 and 40 foot rate, I would expect that to be very, very volatile and relatively unpredictable in terms of volatility. Because with the ceasefire, we are now into this seesaw development we also saw early in the pandemic, where the blank sailings, of course, they already happened over the last 3 weeks. So we will for sure have blank sailings from US back to China over the next 3 weeks, which will wreak havoc on equipment supplies and the equipment repositioning, again having an impact in the split between 20 and 40 footers. Where are they? Where are they available? What do the carriers actually want to move? So in terms of this split between what's a 20 and a 40 foot rate, I would expect this to continue to be exceedingly volatile over at least the next couple of months, irrespective of what the rate level in itself does.
Okay. All right. Well, interesting findings. Thanks for sharing this with us. And as a reminder, we post these podcasts to YouTube. If you're not listening to it on YouTube, we've got the visuals there for you. But okay, let's pivot into more on the trade war. So what do we think is going to be happening? I mean, right now we've got the across the board is 30 or so percent. What can we expect in the coming months here?
At least based on what we heard from Trump and the US administration in the week that just passed, we should expect to hear more tariff increases. That's at least how I'm interpreting it. Or maybe let's be more precise. Exactly what was it that was said by the US administration in the week that passed? It was said that they don't have time to negotiate new trade deals with every country in the world. Big surprise there. And that means that Trump was announcing that Scott Bessent, the Treasury Secretary, would come out over the next 2 to 3 weeks and basically announce what would be the new tariffs on all these different countries. Strictly speaking, this is no different than what happened on what he called Liberation Day back on April 2nd, where the US unilaterally announced what would the tariffs be, basically saying they're going to do the exact same thing. What can we then expect? My guess, and that is purely a guess, let's be honest there, because we don't know what he's going to come up with. If they're going to come up with new tariffs, he is, unless he wants to lose face, going to come up with tariffs that are likely higher than, remember, we all have baseline 10% on every country right now. So for the ones where reciprocal tariffs were higher than 10%, he's likely going to announce tariffs that are, again, higher than 10%, but possibly lower than what was announced on the so-called Liberation Day. We'll just have to wait and see what's being announced. Another uncertainty is the reciprocal tariffs were, of course, all on pause. If we look, let's disregard China for a little while. For all the other countries, they're on pause until July 9. The question then is, if he announces new tariffs, as promised in the next 2 to 3 weeks, will they then come into effect now, or will they come into effect after July 9th, when the pause is over? We simply don't know. There's some logical inconsistencies, because the July 9th was set as a deadline because he wanted to negotiate trade deals with countries. He's apparently already decided there's not enough time to do that. So you could conceivably have a situation where these new tariffs come in before July 9th, which again would create significant problems for a lot of the shippers out there. So the overall theme here is uncertainty related to the tariffs. And the last week didn't create any more clarity. It actually just added yet another element of uncertainty into the mix.
Yeah, Lars, I've got to be honest. If I'm an importer and I'm trying to make decisions about when and if I should be bringing my goods in from China, I mean, yeah, the metaphorical ceasefire is great news, but if we're not even certain that it'll last 90 days, there's not even like maybe a chance that I'll be able to get the benefits of moving the cargo at this point and have a lower tariff rate. Like, it could change.
And you can say that's also what's adding to this push. I mean, the cargo that was already ready and waiting in China, everybody that's pursuing that strategy want to move this as rapidly as possible. And one of the side consequences, I have come across examples of, for example, US shippers that had loaded cargo from China to the US and then told the carrier that, please do not discharge my cargo in the US. Keep it on board, take it all the way back to China, and then we'll turn it once more, because that way they could avoid being forced to import it under the 145% tariff. So there's a lot of weird things going on out there as people are trying to navigate almost on a day-to-day basis what is happening with the tariff.
Well, I'd imagine you're not getting the free ride to going back to China and then back to the
No,
US. So
probably not. But again, purely hypothetical. I don't know exactly which commodities we're talking about. But assume you have $500,000 worth of high value consumer goods in there. If that's 145% of tariffs, then you are going to face a bit over $700,000 in tariff payments. If I can instead pay for that container to take another full round trip all across the Pacific in both directions, that's a lot cheaper than paying $700,000 in tariff.
it's wild. The decisions that people are having to make right now are pretty stressful. I feel for all the logistics teams out there. It's almost like a losing battle right now.
You could say, I wouldn't necessarily call it a battle, but it clearly is a challenge in trying to find out, given the circumstances, what is the right decision? And again, everybody needs to act tactically right now. What is the right decision given what we know right now? We can't plan what we're going to do 2, 3, 4 months down the line because we simply don't know what the circumstances are going to be.
Yeah, definitely. All right, so we're staying buckled in and we're just seeing how things move, but we'll provide updates obviously as things progress. Maybe let's switch gears a little bit and talk about the USTR. What's the latest there?
Well, the latest is, actually today, that must be in 40 minutes from now when we are recording this, there's going to be a hearing in Washington, D.C. If we remember back a bit over a month ago, there was also a hearing on the first USTR proposal. That lasted 2 full days. There was an enormous amount of input coming from all sorts of stakeholders, which then led to a significant revision of the first proposal. This second proposal seems to have received a lot less input in terms of the hearing. Is it going to be revised? We don't know. My own view would be we're probably going to see some more minor revisions, but they are likely going to be minor compared to the massive change from version 1 to version 2. What this means is it's unclear whether it's still going to be implemented in mid-October. I tried to actually this morning read through again exactly what does it say. There's both a mentioning of mid-October as an implementation date. There's also the mentioning of 180 days from adoption of this. So when the first proposal came out, mid-October was actually 180 days out. So whether they're going to stick to mid-October or push it so it's still basically 6 months out remains to be seen. From a container shipping perspective right now, this is going to increase costs. It will hit the various shipping lines, some more than others. It is more manageable. It's not going to lead to this enormous disruption that the first proposal would. But make no mistake, there will be costs associated. And if implemented as it is, those costs, the carriers will likely introduce new surcharges to cover this. That's basically the long and short of it. Now, I know we're just talking container shipping here. That's also my field of expertise. But I understand, especially from some of the ones that are dealing with car carriers, this is a lot more disruptive on the car carrier supply chain. This might be where we potentially can see some of the changes. There's also some issues around LNG shipping.
Do you mind just reminding our audience what exactly we landed on with this revision? What are the implications of it?
With the revision here, there are 2 different types of fees. There are fees on vessels that are operated or owned by Chinese companies. So obviously this hits Costco and WOCL because that's going to hit every single ship they send into the US. It also, as I mentioned, also hits ships that have Chinese owners. So for some other shipping lines, that might be if they are chartering in a vessel that is owned by a Chinese entity, that could be impacted. Then it impacts ships that are built in China. It's not a fixed fee. Last time it was a fixed fee. This time around, the fee depends on the size of the ship. One of the problems the first time around was it was a fee on every single port call. So if I had, for example, an Atlantic service that calls 4 ports, that would be very, very onerous. So everybody would have changed and only called the major port once. That's not the case this time. It's for every time you go to the US. So that also helps a bit. So what you're likely going to see with this one is shipping lines will adjust some of their sailing schedules to try to phase in ships that are not built in China or are not owned in China. This cannot be fully done, but it can be done to some extent. So the cost implications are likely going to be much less. Remember last time it was an extreme cost implication. So this is manageable. It is, in my view, a somewhat unnecessary cost, but it is going to happen. One of the things is important to note, because this has been completely absent from any of the headlines out there, is that in the new revised proposal, this, as I recall, was not part of the first one, but there will now be tariffs on port equipment that is built in China. There will be tariffs on containers that are built in China. Let's be real, all containers are built in China. There's going to be tariffs on chassis and also parts for chassis. So this is actually going to hit a lot of the inland companies in the US. Now, of course, if I'm a shipping line, I'm not importing the containers into the US, but any US companies that are actually importing containers for their own use, there will be tariffs on those. In the second revision, it is not completely set in stone exactly what it is, but the ranges are mentioned, and we are talking tariffs between 30 and 100% on this stuff to be imported into the US. So that's actually going to have an impact inside the US as well, and have so far been absent from that line.
Yeah, that's a pretty steep cost. So most of the drayage companies, the port terminals, ocean carriers, they would be taking the brunt of that up front. But do you expect it would just result in overall higher rates, or you would just have more surcharges on your ocean freight?
For a lot of these, it will not go on the ocean surcharge, right? Because this would be costs that would be directly either on the terminal operators or on the drayage providers or in your inland logistics companies. So they will be facing increased costs, and like everything else, they will obviously try to push this through also through higher prices.
So that new equipment will come at a price for sure, and it might not be
It,
evenly distributed, perhaps.
let's keep in mind that the whole underlying political motivation behind USTR is to move manufacturing to the US. On the ships, it's a matter of getting people to build ships in the US. Quite honestly, when I look at this, this is not going to result in a single additional ship to be built in the US versus the old one. It's just going to be an added cost. But you could potentially make the argument, say, for example, for chassis. There are, as I understand, at least some chassis that are being built in the US. So this could increase chassis building, but there's a reason why most chassis are not built in the US, because it's expensive to build in the US. So you can certainly argue you can avoid these new tariffs by buying American. You can, but that's again going to come at a higher cost. So what is now the most cost efficient solution? Is that to buy American or to pay the tariffs? That's going to be the trade-off. But either way, it does mean higher cost.
Do you know if the raw materials are being imported to build chassis, or would that be something that could be manufactured
That I am
entirely here?
not quite sure. Then we get outside what I know very much about. And the only thing I noticed in the USTR, and that's actually a change compared to the first one. In the first one, there were also some benefits you could have if you ordered ships built on US shipyards. The modification this time around, if you want those benefits, not only should you order your ships in US shipyards, it has to be built with steel that is forged and made in the US and with equipment on the ship that is built in the US. That's actually a tightening of the rule from the first time around.
Okay, interesting. Well, we'll be keeping an eye out on what happens today. I'm pretty curious about it. I'll probably have it up on a screen during the day. But anything else to say about that? Otherwise, we could probably talk about the trade deal between the EU and the UK.
Yeah, I mean, let's move on to, I was about to say happier news. There was a new trade deal announced. We don't have all the details yet between the United Kingdom and the EU. And the reason I think it's worthwhile at least to mention is this is, as I see it, the beginning of what we should expect to see to be a norm in the coming months. Because there has been work done. No, let's start at a different space. Most times when you see nations make trade deals with each other, this is a process that takes years, partly because there's an enormous amount of underlying detail and because there's a lot of political trade-offs that need to be made. And it simply taking a long time. Now, the EU UK deal is basically one they've been pursuing ever since the UK did their Brexit part and left the EU. Now it finally came in place. And there were political thorny issues as well. But what I think we're seeing happening now is because of the US trade war, there is now an added impetus on all other countries in the world to the degree they want to have trade deals with each other to fast track these. And I think the EU UK deal is just one example of it. I would expect to see a lot more bilateral trade deals between countries that don't involve the US, but as a consequence of the US trade war, because a lot of countries are now adopting the position if they are dependent on a lot of trade with the US, it might be prudent to increase trade with other countries instead to reduce their reliance on the US, either for imports or exports. And the way to become less dependent on the US is to have more trade deals with other countries. And that means some of these politically thorny issues, it might be easier to overcome them this time. Let's see if it happens, but there has, as far as I know, for the last 25 years, been a deal in the works between the EU and Mercosur down in South America. And I would not be surprised within, say, the next half year or year that this deal might actually finally happen again for the same reason. We have also, over the last month, suddenly seen China at least initiate talks with both Japan and South Korea on potential trade deals, something that we haven't seen in many, many years. So the reason I think the EU-UK deal is interesting is less because of the trade is going to bolster between the two, but more as what I see is an indication of much more to come in terms of trade deals outside of the US that we're going to see increase because of the US trade war.
What exactly is involved in the trade deal between the UK and the EU?
There's a couple of things involved there. I think the most important things here is actually related to food. The EU wanted access to some of the British waters for fishing, which the Brits have said no to for a number of years. And the Brits want access to sell more of their food in the EU. And that's basically what a lot of this deal is around. Then there are also elements related to defense spending. There will be likely other details, but they are not really disclosed as yet. But those are the main headlines.
Okay, gotcha. Well, interesting. It's good to see some happier news, I guess, with
Oh,
some
yes.
positive trade alliances moving forward. All right. And then I think our last topic today was just to touch on the Red Sea. So what's the latest there, and any good news there?
You can say the fundamental thing is there's not really any change. It is still the same thing. But with the same thing, I think it is important. It might not be talked about enough. I know I've mentioned it sometimes over the last year that whenever we say everybody is going around Africa, it's not 100% true. When we say everybody, we tend to think about the main container lines with their massive ships. They go around. But ever since the breakout of the hostilities, there has been smaller niche carriers that do go through on a regular basis with smaller ships. And that has been the case right from the start. And what we've now seen is OneHigh. And you say OneHigh is one of those carriers. Are they a global carrier? Are they a regional carrier? They're somewhere in the gray zone in between. Announced that they're going to start a service, in this case from India to the East Mediterranean, going through the Red Sea. And the obvious question is then, is this a sign that the major carriers are about to go through the Red Sea? From my own perspective, I would tend to lean towards I don't necessarily see it as such. This is a service that they are operating together with Emirates Shipping Line. Emirates Shipping Lines already have had such a service for a long time, going from India to the East Med. Now, they're just two parties, and as far as at least I can ascertain for now, that means this service goes from being a monthly service to a bi-weekly service instead. So every 14 days, there is a sailing going. Is this going to increase the capacity that goes through the Red Sea? Marginally so. But I don't see this as a major fundamental shift in the risk assessment where the majority of capacity is going through.
Okay, gotcha. All right. Well, thank you for all the updates. I think we had a pretty content-filled episode today. But on that note, I think we're going to sign off, and we'll be back next week, bright and early Monday morning to film. And I hope you all have a productive week.
Yeah, great week, everyone.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.